audit, and taxation. Financial reporting is solvency, winding up and business recovery, compliance and regulatory matters, and general management. He has, over that period, consulted widely of high net worth and major corporations in Nigeria and beyond in sectors including but not limited to manufacturing, telecommunication and information technology, insurance, oil and gas, engineering, medical, law firms, non-governmental organizations, partnerships firms, internal revenue services, and many more. It will interest us to know that he is a graduate of accountancy and a senior member, fellow of both the Institute of Chartered Accountants of Nigeria, ICANN, and the Chartered Institute of Tax Practitioners of Nigeria, CTIN, and associate member of Business Recovery Practitioners of Nigeria. He holds a diploma in International Financial Reporting with AFCA, and is a registered member of the Financial Reporting Council of Nigeria. Bravo. Mr. Kochu. He is a certified business advisor and associate member of the Institute of Chartered Accountants, England and Wales. He regularly trains and attends professional trainings in the areas of his expertise. Let's welcome Mr. Adepoju Bamidele. You're welcome, sir.
Thank you so much. Am I supposed to stand there? Okay, let me start.
I don't know.
Well, we are very proud of you. I want to thank the management, senior managers, and every other person here this afternoon. I see it as a privilege to just come and share the bit of what can benefit us. This is the topic I was given about meat. So just make an attempt. Okay, so when we talk about volatile business environment, volatility means unpredictable, very unpredictable business environment. Business is not in isolation. You have to do it in a particular level. Even though we are not in a global village, but it's important to know that our immediate environment, Nigeria, where we operate, is volatile. You see volatility in terms of constant changes and unpredictability. We talk about rebasing the inflation rate. When you rebase it from 39 to 23, start growing it back to where it used to be. Because the drivers of the changes are not being well addressed. You see, so many things are happening in the economy. So it's really, really volatile. And we need to know how to manage cash flow. Now, the cash flow, what you call cash is an asset, accounting wise. It's one of the assets you can put up in the business. So my objective this afternoon is to, from this presentation, to be able to show that, to encourage adherence to credit terms with clients and vendors. So that's one of the objectives. Number two, ensure efficient management of receivables and payables. The need for continuous customer engagement and strengthening self-business funding. That is to say, how you can fund your business organically, the most cheapest way. So those are the things that this presentation will achieve. So let's go to the next. Okay. How much did you do this for? Okay. So. Okay. Okay, thank you so much. Am I still ready?
Yes.
Okay, so because we are talking about cash, the main thing this afternoon is cash. So I want us to quickly look at these quotable quotes on cash because it's going to help us to help some of the points. Cash flow is the lifeblood of any business. According to Richard Branson, A business without cash flow is like a car without gasoline. It won't go far. See what I'm saying? Cash flow is oxygen for a business. Without it, you suffocate. Or no? The revenue is fantasy. Profit is vanity. Cash is sanity. Yes. So we can be rejoicing that, oh, look at that number. I saw the way, the account manager was throwing the numbers and all of that. It's very good, but it's fantasy. Profit is vanity. You can have profit on the books, and you actually don't have profit because some of them can go back, or you call bad debt. But cash is sanity. Above all, we need to have revenue, we need to have profit. Then it does turn to cash because it's cycle. But it does to cash. The whole thing is just fantasy and vanity. So there's what is called cash operating cycle. And this is very important for us to do. Because let's look at edge-based, the type of business we do, where the distribution of computers and accessories, one of the major distributors. So, looking at our own cash cycle, I try to look at it. I realize that it's likely to be 3. When you purchase inventory, then we sell. It moves from purchases, cash has gone out. Then we sell the same inventory to our own customers. Then cash will return from that same customer. So it's just like a cycle. So the cycle is endless. Purchase, sell, collect cash. Purchase, sell, collect cash. So that is just the cash operating cycle that has to rotate many times within the financial year. So you can realize that if we don't understand our cash operating cycle, what you call cash conversion cycle, it's very possible that you lose money. Yeah, that's how you lose money. So when we're able to master the cycle, because for each cycle, I believe it has been a structure of edge-based. If I still really understand it, that's not changed. Actually, you have inventory. You have the inventory guys. Yeah. So they are managing that point. Then you have the sales people, the sales team. Very, very important. They are managing that also contact. Then in terms of cash collection, I don't know how the structure will be in tech-based, but definitely there are people in charge of making sure that the money return back, at the right time. Because if it doesn't return at the right time, you will still lose money, especially where rates is changing. You buy in dollars. At the point of purchase, you buy in dollars. You are buying in dollars. By the time you are selling, majorly you sell in naira. That was already a risk. There's a market risk in that cycle, in that movement. Then by the time you now sell, you still collect mostly in cash in naira. So the longer the cycle, the longer it goes, the more risk you're exposed to: market risk, exchange risk, all of them will be credit risk, inability to pay back, or not to pay back at all, which is what we call bad debt, or to pay back at the wrong timing. So this cycle has a lot of risk: market risk, credit risk, and so on and so forth. So that is the typical cash operating cycle that edge-based believe that we have. So now, specifically, I'm speaking to these 3 points in the cycle: the inventory people, the finance team, and the sales team. Okay, so this one goes to the finance team. We must be able to establish a threshold of our operating cycle. When I say threshold, as of today, what is our operating cycle? It can be computed. Cash operating cycle, it can be computed. And when we understand it, because the shorter it is, the better for us. The longer it is not good. The shorter, the better. A client can come that when we master it, you can even be setting targets, especially to people that are collecting cash, to make sure that this cycle should not go beyond 13 days, 14 days, 15 days, 17 days, however. But we are going to that now. There's a way to compute operating cycle, cash operating cycle. So there are three elements, and they are standing for, one is standing for inventory, one is standing for finance, and one is standing for sales. So the first one is what we call DIO, days inventory outstanding. The number of days that inventory were kept in the warehouse, that we are putting them up. Then we also have DSO, days sales outstanding, time taken to collect cash from customers. The third element is DPO, not district police officer. Days payable outstanding, time taken to pay suppliers. So we have time computers remain in inventory, that's DIO. We have PSO, time taken to collect cash from customers. Then we have DPO, time taken to pay suppliers. So, having understood the three elements, now let's take a case study, just a very simple illustration. Now, let us assume that we have DIO 30 days. That is the number of days that computers stay in our inventory, averagely 30 days. Our DSO, which stands for customer, the days that stays for outstanding, 45 days, that's specific 45 days, for example. Then we have DPO, 60 days. So how it is computed is to now say 30 plus 45 minus 60, that is DIO plus DSO minus DPO, that's 15 days. The interpretation is that a shorter cash operating cycle indicates better working capital management. In this example, the company takes 15 days to convert inventory into cash after paying suppliers. So this is a challenge to find out what we are doing. Just look at from what we did in the outgoing financial year. Let's look at average of DIO, average for the year, for DSO and DPO, and be able to establish what is our cash operating cycle. You can also go to another previous year and do that, maybe like 3 years, and look at the trend so that I can establish whether we're now having a longer cycle or a shorter conversion cycle. It's very important. That will also help us be able to, adjust a lot of things. It's important. The shorter it is, the better for the working capital. Okay, so let's look at roles of sales department in cash flow management. So I just try to get something that looks typical that's identical to your type of industry. I do not know how your sales are structured here. But one thing is sure, that salespeople, they maintain customer relationship, they do customer relationship management. But people only buy from people that they are comfortable with. If there's no chemistry, there's no sales. Chemistry is very important. Valuing, customers. So they maintain that relationship, and they help to foster stronger relationship, which can encourage timely payments. Sometimes it happens almost everywhere. When accounts are finding difficult to get payment from a customer, and just remember, this is person has a good relationship, can go to person. My brother, how are you? How are you? Let's start up the game now. That is really good for a long time, you can just get it. Because for every company, they do a score. I don't know how it is done within tech ways, but typically sales people, when they are, it's a process. Sales is a process. A lot of negotiation, give and take up the rest. The terms are established. So payment terms are very important. Because you will still need the illustration I gave the other time. It's a typical wisdom when you are dealing with cash flow management, that your receivable days should be shorter than your payable days, payable terms. If I'm going to be collecting payment from my customer 30 days, it's typical that for people that I'm going to be paying, you always have received one pay. It should be longer than that. 30 days to collect money, 40 or 45 days to pay money. So that way, you have a short of 15 days, to use somebody's money
limit the trade. So that's just effective working capital management. So when we are negotiating terms, it's what of us to liaise with finance. That's what to be done. What is your payable terms when you want to pay your own vendors and your own, suppliers? Oh, I was able to achieve 40 days. Then for us as sales, it has to be lesser than that. So that 10 days of this short absorber can be there to manage wherever it is that function. You understand? So that's the technical wisdom. So, and sales forecasting is one of the things that sales people do. They forecast sales. Oh, well, they give me a target. I will see like Google and all those products are flashing on the screen. Okay, so if you have the target, X, Y, Z, what is the timing? What are we looking at? You see, on 30th of March, the 30th of April, that we're like, it says likely to come. So there won't be what's called sales forecast, properly spread out. That is not done by finance, it's done by sales. Not just having budget, Q1, I was achieving this, there must be timing to it. Because if that is done, there's a way that the collaboration will help sales and finance. Finance do what is called cash budgeting. I'm sure I'm very present. They do cash budgeting. Cash budgeting has to do with when this money is like when it's likely to drop and when we're likely to leave money to pay. Just purely cash movement. So when you have forecasted sales, that is spread, just the way they do cash budgeting. And the financial people will be able to have that and have it in their own cash budget. It helps them to do what's called realistic cash budget. Realistic cash. So those are some of the things that help in cash flow management, where there's that strong collaboration between sales forecasts done by sales people, then the cash budget done by finance. But in a typical situation as well, you have a situation where maybe the sales don't have the skill to be able to spread out the weight. If they approach finance, that look, this is what I'm trying to do, the guy can do it. So, because the important is that sales must have time, projected time. Q1 was going to sell this, but how is it going to come? With your strategy, you can know that I can allocate number to this time and that one down. That will help a realistic cash budget that finance people. So at any point in time, there will not be shortage of that because there is an alignment between sales forecast and cash budget. Sales forecast done by sales department and cash budget done by finance department. So let me go to the next one. Please, are we together? Yes. Okay. So we have the roles of inventory and cash flow management. One of the things they do is to ensure optimal inventory management. What's called optimal? Optimal has to do with a situation where you don't have the stock, hanging the stock for too long. The longer the stock stays in the warehouse, it has what is called holding cost. The longer cost you incur. One of the costs will be obsolescence. When you are dealing with technology products where another edition something has come and the price of this one will drop. One of the costs is insurance. The longer I say the more you pay insurance, the warehouse and all of that. So optimal stock level, it must be established at the point in time. We can't be going above this level of inventory in our stock. Very important. And I know that you have a tool, you have an ERP software. If it is effectively used, all those tools can be used to ensure that we achieve optimal level of stocking or inventory. The longer it stays, the more cost, the more cost that the company will have. So, and I also know that, I don't know whether it exists. There are some of I know there are theory uses that they brought, but it's also there's something called just-in-time PIT, where instead of you bringing, because I work with Sherman many years ago, I used to be an accountant, I was now the sales of engineering. So I know that something many other products, it doesn't come straight to the office, to the warehouse. It goes from the point of buy to the point to the customer's place. That's what they call GIT, just in time. If that is encouraged more, when you do that, you are avoiding certain costs, holding costs, loading, offloading, breakage, maybe stealing, insurance. You are avoiding it. So when all those things are encouraged, the store person can be able to achieve optimal inventory level. It's something that has to be established going forward. What is our optimal? That we must not go above. We go above it, we're already causing problem. as far as cash flow because they're holding that money. If you buy a stock and you can't sell the next 150 days, the supplier will have taken his money. And while the stock are in the store, if you have taken bank loan to stop the purchase, the bank is lending to the bank. Then you have the product hanging, the insurance, the risk of being stolen or being thrown, obsolescence, then interest, even the profit you want to have is eroded because it has stayed too long in the warehouse. So the role of warehouse manager is very, very critical when it comes to cash flow. Him and his team to ensure that they have optimal stock level and all of that. Working with finance, I work with safety. All right, so I talked about EIT. That's insurance supply chains, reduces lead time. So when we're ordering, when they are ordering, to ensure that the lead time, is short. The longer it stays, the more. For example, you are ordering the product and it gets to I don't know how you do your clearing, and it's being held back. Then break can take place and all of that. But everyone lose the confidence of the customer that order buying. See, because all of us are working towards one thing, just to make sure that we achieve target and maximize our revenue and profit. So if one part, it's a chain, that cycle, if it's proof or delay, it affects many things. And one of the things that we don't see is a good way that doesn't really come to the table. Is a good way of headaches. It's a good way. They perceive that when these guys say it, they can underfront or deliver. They don't under-deliver. So, but it's not only one person, it's a chain, it's a cycle. So each point will be very strong and effective to ensure that at the end of the day, we not only achieve a good profit, but our goodwill is enhanced right before the buy. All right, so roles of finance in cash flow management. Like I said the other time, they help you what is called cash flow forecasting, into and after cash flow, because cash budgeting is something that must be done regularly, so that there will not be. So when you do cash flow budgeting, what it does is that you cannot have an insight into when you don't have, certain businesses have peak period and not peak period. You are going to know when you don't have much business, much cash, and you don't need more cash. So you can arrange such a way that when you don't have much cash, you have to source for how do we fund this thing at this particular time. You understand? So taking a look at 1 year ahead. 1 year ahead. So cash budgeting is done 1 year ahead, but it's broken down into month by month. See, so then account receivable management. So finance team ensure that there's a timely collection of receivables. But this one cannot be done without having the proper terms, sales terms that bring it written. I understand that because of relationship we have, sometimes ongoing relationship. Oh, I want something, I want something. You may even forget to even put it in writing. Or if they're not going to be contract signed, let us be made that count us what we are going to. The terms is very important. Because when the receivable accountant is posting an invoice, I'm an accountant, so I can drill down into that one. When you are posting an invoice, you are not only posting numbers and quantity, you are also looking at the term, you are posting the terms. 30-day collection, 45 days. So at the end of the day, there's what we call age analysis of your receivable. So easily you can see when this thing is due to you. And sometimes with the ERP you are using, you can even set alert to say that 5 days to consecutive periods, you should be giving alert. Sometimes they can set a template, just an automated letter, that when it hits this day, please every send a reminder to this particular customer. You get it? So those are some of the ways you manage receivable, using ERP. And account people as well. Of course, it's also the opposite of receivables. But you see, one thing I've noticed with companies is that, maybe with everybody, I was in a place one time many years ago as a copper in the University. So the big man, chief, called for a meeting, very big, one big hall, including we co-as we are privileged to be there as professors, emeritus. He said one thing that I can't forget. You see, it's not a man that's well versed in education, but he loves education. He now said, when they taught us something in commerce, that there are two pipes in business. One pipe is large, big. One pipe is tiny. The one that is large, big, is one that brings in money. The one that is tiny, one that takes out money. Don't forget. So native wisdom for cash flow management. That is to say, let more money come in, less more money goes out. But there's a caution, there's a caveat. You know, sometimes we feel that I give that 30 days to collect money and I collect it. 45 to pay, I didn't pay. You will lose goodwill. One of the ways to actually fund business, one of the cheapest ways is to have goodwill with your vendors. That you can just do like this and they will send it to you because they know you are always up to time. And the time you will not be up to time, you send them a mail, sorry, we have a little delay, but give us time, we will pay. This is very important because goodwill is very, very important. So the man was saying, big pipe, small pipe. I don't know the kind of pipe we have in Equis. If it is big pipe, small pipe, even without small pipe, you must ensure that it's not too tight. So at the end of the day, the goodwill on side of pay is maintained. So I can get things done sometimes without taking too much of paper, we know them. For example, now you see certain companies doing commercial papers in Nigeria. MTN did commercial paper last year by 3 or 4 times. And for offering by 23%, thereabouts. It was oversubscribed within 2 days because of the goodwill of that company. Another company that is not known, if you go and try that, even with 30%, people will not buy. Because we are not being tested and proven. It's very important. So payable accountant, please don't think that you are doing the company a favor by not you want to maintain tiny pipe. It can be counterproductive. Very important. Right. So working capital management. Finance team, I believe they take the lead in working capital management, cash. They have much more responsibility than sales and the inventory. They understand what capital management more. Well, it has to be by collaboration. Sales, inventory, and finance. The whole of finance. There must be collaboration.
We are very proud of you. I want to thank the management, senior managers, and every other person here this afternoon. I see it as a privilege to just come and share a bit of what can benefit us. This is on the topic I was given.